Hi, I'm Nick Schultz. My guest today is Jim Glassman. Jim, who was a former fellow here at the American Enterprise Institute, is now the president of the George W. Bush Center at the Bush Library in Dallas. Jim, welcome.
Thanks,
Good to have
Nick.
you here. I want to talk to you today about a book that is getting a tremendous amount of buzz. It's called Safety Net, The Strategy for De-Risking Your Investments in a Time of Turbulence. Now, Jim, you've been writing about stocks and financial issues for almost your entire career. In that capacity, you're probably best known as the co-author of the book Dow 36,000. And I think it's fair to say that this book comes out of that and out of some of the experiences you had in writing that book and what's happened since then. You wrote Dow 36,000 in 1999. Before we get into this book, I want to talk about Dow 36,000 because I think that was a book in some ways that was misunderstood. It's obviously a very provocative title. It sounded like you were predicting the Dow was going to go to 36,000, which it hasn't, obviously. What was that book about? Because I think it's important to set the stage for what we're going to talk about with this book.
Right. Well, Dow 36,000 was a book with a very flamboyant title. Maybe it went the title may have gone too far. But the book was about something that economists have pondered for a long time, which is what's called the equity premium puzzle. And that is that stocks, historically, have returned a lot more than bonds, about 5 percentage points on average over the last 200 years. And it's been pretty consistent. And yet, for long periods of time, 10 years, 20 years and more, stocks are no more risky than bonds if we define risk as volatility, which is the standard financial definition of risk. So this is a puzzle, so why is this? And in Dow 36,000, Kevin Hassett and I made the argument that this puzzle was being resolved by investors as they grew less afraid of stocks and therefore less irrationally inclined against stocks.
And you argued at the time they were right to do that.
Correct.
They were right to not be so afraid of the risk or the seeming risk of stocks.
Right, exactly. What we argue was this was the reasonable thing to do, and in fact their aversion to stocks, the risk aversion, was irrational. So they were acting emotionally, and that they were waking up to the fact that, gee, stocks are no more risk, actually are no more risky than bonds for a number of reasons, and therefore bidding up the price of stocks and thereby bidding down the returns of stocks. So at some point, and we kind of guessed it would be 36,000, stocks would reach their proper level and returns would decline significantly. And so during that period of stock price increase, we thought, this is an especially good time to be buying stocks. But even if you didn't go along with that, the argument in Dow 36,000 was really a fairly conventional one, which is that when you look at stocks, you look at bonds, you look at their returns and their riskiness, investors who have a long-term perspective should really load up on U.S. equities.
Okay, and now we fast forward to today. Obviously the Dow's been up and down a lot. It's not anywhere near 36,000. And you say in this book you were wrong. What were you wrong about?
Right. The Dow, just to be clear, the Dow is up only about 25% or so since Kevin and I wrote that book. And if you looked at even with dividends, the returns have only been an average of a few percentage points a year, so not very good. Okay, so what I conclude in this book, and this took me a while, over the last few years, I've sort of reluctantly come to the conclusion that the world has changed. And so to base an investment strategy on history, the last century or the last 2 centuries, is not a good idea. So I'm telling investors, look, this is a different world from what it was in the 1990s and the 1980s and going all the way back. And you need to adjust your investment strategy to be in accord with this new world. And let me hasten to say that we don't know what the future is going to be. I started off with a quote from Peter Bernstein, who just died about a year ago, kind of the great writer about risk. And he says, the most important thing for people to understand is that we don't know the future. But we tend to base our decisions about the future on what happened in the past. But sometimes the past is not a good reference point for the future. And I'm saying that things are changing. You need to recognize that, change your strategy.
But are you saying that this equity risk premium puzzle, because why was it that stocks were seen as so risky yet their historical returns, over time, the risk seems to diminish. Are you saying that it's no longer a puzzle because they are risky enough that investors should demand this premium? Is that basically what you were saying you were wrong about?
Yeah, I think it's a very good way to put it. We were basing this puzzle on a certain definition of risk, the standard definition of risk, which is that risk is volatility, the extremes of the ups and downs of the stock market. Now, there's another kind of risk, and that is generally called Knightian risk, after Frank Knight, who was a great economist, wrote an important book in the 1920s and later became the chairman of the University of Chicago Economics Department. And he coined this term uncertainty. Well, we use that in lots of other ways, but he meant it in a specific way, and that is the kind of risk that you can't quantify. Stock market risk, volatility, we can quantify. It's just like coin flips. You know, we've got an idea that, you know, if you flip enough coins, it's going to be 50-50 heads and tails. Same thing with the stock market. We've got a pretty good idea what returns are going to be if you look at history. He's saying there are these kind of discontinuous risks that we really need to take into account. And it's my view that that risk has been ratcheted up, but at any rate, even if it's not, we need to take that into account. And so investors, in my view now, looking back, really were taking that kind of risk into account, and that their risk aversion was not, in fact, irrational, although we couldn't quite find where it was. It was actually somewhat rational, and it's a kind of an act of hubris on my part to say that they were wrong, that in fact, you know, they were right. Maybe they're a little bit overly emotional, but generally they had a point.
Now you have, with Dow 36,000, you were arguing that investors with a sufficiently long time horizon should be heavily invested in stocks. You're now saying that even with a long time horizon, say 20 or 30 years, that's not so much the case, and you should be about 50% in stocks, 50% in bonds. How did you come to this allocation and this level of diversification, not just across types of stocks, say, but also into other asset classes and the like?
Well, very simply, I believe that investors should only be in stocks and bonds. I think that commodities are not for the average investor. And the best way to kind of adjust your portfolio, the most important decision you make in investing is allocation. It's not the individual stocks you buy, the individual bonds you buy, but how you allocate your assets between these two classes, stocks and bonds. And if you allocate a lot of your money to stocks, what you're going to get is a very bumpy ride, even if the future is like the past. So I'm telling people to do this, to make a change, that is to say ratchet down the amount of stocks they hold versus bonds to a kind of default position of 50-50. And the book goes into more detail than that, but it's basically moving from, let's say, 80-20 or 90-10 for someone who's in his 40s, let's say early 40s, going to retire in mid-60s, down to 50-50. And I'm really doing that for two reasons. One is, as I said earlier, I think the world has changed. Returns are not going to be as great with stocks for a number of reasons, one being that the U.S. economy is declining in a relative sense compared to other economies and compared to what we did in the past. But I've also come to the conclusion that it's time to sort of stop telling people to eat their spinach, that they're not going to do it. They're going to do it, but they're going to feel really bad and very nervous doing it. So I think it's actually out of respect for investors that I'm saying to them, you know what, I know how hard it is to ride out the bad parts, and simply to say, persevere, you know, things are going to be bad, you're going to lose 50% of your money during certain periods, but hang in there. I don't think that's a practical advice for most investors. So what I'm saying is, this will give you a smoother ride. It will protect you on the downside, this asset allocation. Now, you're going to give up something on the upside. I'm not kidding anybody. There's no free lunch. But the amount that you give up on the upside is actually quite small compared to the comfort you get from being protected on the downside. And that's what this allocation does.
You say it's quite small, about 2% or so. But if I could channel the old Jim Glassman, I would anticipate him saying, Well, yeah, you say 2% doesn't sound like a lot, but compounding over time,
Right.
2% adds up to a lot. So how do you address that? If you're talking to an investor, you mentioned somebody, say, in his early 40s, got 20, 25-year time horizon, says, gee, I look at what 2% is going to amount to over time, and maybe I'm going to roll the dice.
Right. It is. Look, yeah, 2% is significant. I don't think it's a whole lot, but it's significant. And in some years, of course, and that's just the average. Some years it won't be 2%. I'll give you two years that I think are very instructive. Okay, 1997, the stock market S&P 500 was up 33%, returned 33%. A 50-50 portfolio returned 25%. So you're giving up 8 points in that year. In the really terrible year of 2008, the stock market was down 37%. A 50-50 portfolio was down 10%. So if I offered you that choice in these two extreme years, I think that most investors would say, well, that's pretty good. Yeah, I am giving up something in the good years, but I'm protected in the bad years.
Right.
No, it is significant. It's an insurance policy.
Yeah, and you
give a lot
you give a lot of good detailed advice in the book to investors about how to construct a portfolio that might be able to do that. I get two quick questions for you, and then that's all we have time for. One's a question about political economy. There was this notion that was fashionable, 10 years ago about the need for the country to move to an ownership society. And part of that, I think, was premised on the notion that if you get people investing, say, early on in stocks, and they can let their assets and wealth build over time, this will go a long way towards alleviating some of the problems that we have as a country with a social safety net that we can't afford and the like. Fast forward to today. Are there implications for your book for things like this notion of the ownership society, or for questions about Social Security and how people should think about their retirement and plan for their retirement? What would those implications be?
Oh, I think so. I think it's very important. I think it's clear that if politicians finally do their duty, the benefits to Social Security are going to decline, and it's going to become more obvious for people that that they're on their own and they've got to do more savings. And what I'm saying is the prudent thing to do for most investors is to have an allocation that's closer to 50-50 than it is to 80-20. And get started with that right away so that you don't feel tempted when you're in your 50s to take big bets and put too much money into stock. But absolutely, I think people should be investing for the long term, not counting on Social Security. And if you're at a 50-50, or take some of the other advice that I give in this book, in Safety Net, then I think you'll have the kind of smooth ride that gives you confidence to stay in the market.
Final question for you. One of the things that you say that's changed, that you say that the world has changed and that's changed your thinking, is that the United States has entered a period of lower growth rates than in the past. And we can talk about what the reasons for that is. But you're involved with a very interesting initiative at the George W. Bush Institute that you've helped spearhead that wants to push for accelerated growth rates on order of 4%. Talk about that initiative and some of the things that you're doing, because I think it's pretty interesting stuff.
Well, the Congressional Budget Office, among others, is projecting long-term sustainable U.S. growth on the order of 2%. We'll have we'll probably have a blip upward in the next couple of years, partly off a low base, recovery from the recession. But after that, long-term, not very good, 2%. So our initiative, which we call the 4% Project, is to bring the United States up to 4% growth. Our average growth for the second half of the 20th century was 3.5%, and I think our aspiration should be higher than 3.5%. So how do you do that? Well, there are many, many different ways to do it, and we're going to be examining some of those at our big conference on April 12th and 13th, and then home in on the ones that we think are the most important. So I don't have the answer yet, but it's monetary policy, it's trade, it's absolutely immigration policy, which may be among the most important things we can change, bringing in a kind of higher skilled immigrants. It certainly is fiscal policy, more sensible tax policy. It is spending cuts, but not spending cuts for kind of their own sake or some sort of moral reason, but cutting spending in order to boost growth. So the idea is that 4% growth is the kind of organizing principle. And the relevance, I think, of this to the book is that one of the foundations of the book is the notion that the United States is going to grow at 2%. Now, as I say at the end of the book, I sure hope it grows at 4%. It may grow at 4%, but I do think that people need to be prepared for slower growth. And if we're delightfully surprised that growth is greater, then in the other parts of your life, in the salary that you get, the value of your home, that sort of thing, you're going to see a major increase. And so, you're not going to feel all that bad if the returns to your stocks are lower. But I do believe that even with this perspective of getting higher growth, people need to be protected.
Okay. Well, to find out how to be protected, the book is Safety Net, The Strategy for De-risking Your Investments in a Time of Turbulence. My guest today is Jim Glassman. Jim, thanks for coming by.
Thank you, Nick.